Okay, guys, we're going to do something a little different this week. We've put in some new camera software, some new things. We're going to take a look at the state of banking for April 2016. Now, we are spending a little bit of money around here. We haven't done too much yet with new sound equipment. We've tried several things. Not really impressed with any of them so far, but we're going to keep working on it. But these presentations should just get better and better as we go on. No fun just looking at my mug, handsome as it is every week. So we're going to try to add some things and learn this new software and bring you some better presentations over time. Now, my youngest has a kid. She's 13. Has a kid in her class that's doing these presentations, very high quality. I think I'm going to pay the guy to come down here and show the old man how to do this stuff. I'm not a Luddite, but I'm not real experienced with technology. And my crack staff is more interested in naps and walks, so she hasn't been much help either. We did a version of the state of banking last year at about this time, so I thought it might be a good idea just to kind of check in with where we are in the trade of the decade that I've talked about for several years now in the small bank stocks. Now, I've been a small bank stock investor since the early 1990s, and we've done very well with it over the years. It's kind of a neat trade because at the time that you really should be out of these things, 2007, 1999, the price to book value ratios are so high that you end up kind of not owning any. You're certainly not putting any new money to work. But following the credit crisis, as we got into early 2010 throughout that year, you could see the setup. It was pretty easy to see what was going to happen. We called it the trade of the decade. I still do. The new regulations, we're going to talk more about that have been piled on top of the smaller banks. The fact that banking simply is not fun anymore. The rising cost of technology to keep up with the big guys all made a lot of the little banks, they're thinking maybe they'll sell. It's too tough to remain independent. At the same time, the only way to grow in a slow growth economy like we have right now for the slightly larger banks is to buy. So for every seller, we've got, at least one buyer, in most cases 3 or 4, taking a look at buying in the bank. So the trade of the decade is still very much alive and well as we sit here in the post-tax day environment of April 2016. Let's take a look basically at where we are in the banking business, hit on the big factors. We've seen an epic rebuild of bank equity post-credit crisis. Now, a lot of the loans they used to make, they can't make anymore. Certainly the lending criteria have gotten tough. Loan demand has gone down. So the equity has just piled up on the balance sheets. Back in the 2010, 2011 period, a lot of banks raised capital in the form of preferred offerings, common equity offerings. But as you can see, the equity to assets ratio throughout the industry are about as high as they have ever been. And with the new regulations, equity levels are going to remain fairly high. I think you're going to see banks that get their equity to assets ratio too much lower than, say, 8 are going to get a knock on the door from the regulators. Most bankers will go to incredible lengths not to have to deal with those guys any more than they already do. So I think we'll see equity levels remain quite high throughout the industry for the foreseeable future. Non-performing loans, you could see what happened in the credit crisis, that huge spike up to about 5.5% of total loans. We've worked that down. We're almost back down, not quite to the 2005, 2006 levels. It's going to take a while to get there. We may not, but the big thing to consider is that, we have been in the sweet spot as far as credit for an extended period of time now. The lending standards have been very tight. They remain tight. Certain types of risky loans have been discouraged by the regulators and pushed off to the business development companies and the private equity firms, creating, by the way, a whole separate sort of opportunity over there. But that's for another session. We're in the sweet spot as far as credit. We may see upticks. I know Chris Marinac of FIG Partners has been talking about the need for banks to begin to consider increasing loan loss reserves because things are just about as good as they can get. While that's true, I don't see credit getting bad at a rapid rate like we saw in, say, 2008. If we see some upticks in non-performing assets and non-performing loans, it's going to be very, very slow, with one exception that we'll talk about. The return on average assets, you can see, it's come back up from those disastrous levels of 2010. Not as high as it was pre-crisis. The same is true for returns on equity. And the simple truth here, guys, is that those returns may never get back up to those levels, or at least until we get some regulatory amnesia, let's say, because the constraints, as I said, on higher risk, higher return types of lending, and the amount of equity that must be kept on the balance sheets, going to make it a little tough to get back up to those 15% returns on equity on average. There are some banks, usually banks that are, the master acquirers. Bank of the Ozarks and a few others come to mind here. Home Bank in Conway, Arkansas, just do a fantastic job of continually growing earnings by buying other banks. And love those banks, can only buy them in the steepest of corrections. But the serial acquirers can make you a lot of money over time if you buy them correctly. Again, the returns on equity on average for the industry, probably not going to get back up to those pre-crisis levels for an extended period of time, but they are well above where they were at the height of the credit crisis. So all in all, conditions are not too bad. Now, here's where there's a problem. Net interest margins are at historic lows. I mean, that's the number that banks, that's where they make their money, the difference between what they borrow from other banks or from the Federal Reserve window, what they pay on deposits, and what they relend money at to consumers and corporations. It's very low. Unfortunately, it's not going to change. There had been some hope in the industry as we saw the first interest rate increase. Maybe we'll see a steady trend, and quarter after quarter after quarter, the Federal raise rates, and those net interest margins will come up, and we'll be able to make some more money. Small banks were one of the few sectors of the market that they were excited. They wanted higher interest rates. Well, the economy is not cooperating. They may get one, maybe two. Some people are saying two now, more hikes in 2016, but it's not going to be every quarter. The economy simply refuses to cooperate. We'll be lucky to have 2% GDP growth for 2016, probably even 2017 here in the United States. As Sam Zell said recently, that you look out at the economy and you have to ask yourself, where is the demand coming from? There's not a lot of demand for consumer goods and services, and corporations are terrified to spend money, so they're using it to just simply buy back stock and pump up their earnings and engage in a little financial engineering that increases the stock price and everybody's option price for a period of time. In the current political and regulatory environment, corporations would rather sit on the cash, maybe pay a dividend, which would be my preferred course of action, or they buy back stock. Now, I'm not a fan of buying back stock at high multiples of earnings or book value. And a recent study that was posted on the Harvard Corporate Governance Forum shows that, in fact, managing your earnings by buying back stock is, in fact, it's destructive to things like research and development and jobs growth. But I wasn't really asked about it. So rates are not going higher anytime soon. We just do not have the level of economic growth and activity to justify any more increases by a very nervous Janet Yellen and her fellow central bankers. It's just not there. It's going to be very slow. Net interest margins going to stay low, so the banks are just going to have to figure out a way to make money with lower margins than they're used to operating with. Here's the big story. And this chart goes all the way back to 1985, and you can see we peaked out there. Commercial banks, about 14,500. The total, including thrifts, was about 18,700 institutions. Now we're down to about 5,300 commercial banks. The total number, including thrifts, is somewhere around 7,000 financial institutions. Ever since they passed in 1987, the new interstate banking rules, and they relaxed them again one more time. Slowly but surely, you have seen the number of banks decline in the United States. Now, since 2010, it's accelerating. I think it's going to continue to accelerate. You're going to see something like I think the normal's around 3% of banks consolidated every year. I think that's going to go up to 4, maybe 5% for the foreseeable future. And that's a huge opportunity for us as investors because we can still buy these things fairly cheaply. We're going to talk about that just a little bit more here in a minute. And the average takeover multiples are just steadily ticking up. So if we could buy them at 85% of book and sell them to an acquirer at 130 or 140% of book value, I'm a pretty happy camper. Particularly given the fact that again, Chris Marinak at FIG Partners, who I think is one of the best bank research guys out there right now, points out, book values are growing, for most of these banks at 6-7% a year right now. So you've got to grow in book value and a higher multiple. You get a little double compounding effect if you're able to hold these stocks for a couple of years. So all in all, it's pretty much the same as last year. The consolidation continues. It's going to continue. Banks, especially the smaller banks, are in pretty good shape. They have lots of equity. Non-performing assets are not unreasonable. The biggest problem that they're facing on an operating basis right now is those horribly low net interest margins. Now, what are the problems? Okay, well, these two guys are the biggest problem for the banking industry. And, of course, this is the Dodd-Frank bill passed post-credit crisis that's not completely implemented yet. There's new regulations seemingly every day, and every new regulation comes down that banks have to comply with involves more time and more money spent on legal expenses, for regulatory and compliance personnel, and time spent making sure that you're in compliance with all these fancy new rules and regulations. I've talked to bankers who have gone from having one in-house attorney to having to pay for office space for as many as a dozen regulatory employees in their home office building. It's a serious expense, and as we've seen, the net interest margins are already making things kind of difficult in the banking industry. Now we're going to add dramatically increased regulatory costs on top of that, and a lot of the smaller bankers especially are saying, you know what, we're just done with this. It's too hard to keep up with all this. Talk to a lot of bankers, and they tell me in this environment that you need about $1 billion in total assets to be competitive and to deal with the regulatory costs, to attain the type of scale that you need to deal with the regulatory costs and issues. And about $5 billion, you're really in sort of the sweet spot where you've got that sufficiently spread over enough assets that it's not that big a drag on the bottom line. Of course, when you get to $10 billion and above, you get a whole new level of regulation coming in. But again, that's for another seminar. Now, next we have a rising risk. This is a big one. Cybersecurity. The cost of it's going up. It's not going to stop anytime soon. Cybersecurity, this is where the new Dillingers and Capones live, folks. They live on your computer. The hacking is constant, especially financial institutions. There's major risks associated with this, not the least of which is reputation risk. If your bank's continually getting hacked, your data is getting compromised, you're going to switch banks to somebody that's doing a better job. The problem with cybersecurity is every time you fix one problem, the crooks find another one, and it's really shocking how much of this is going on out there. I talked to a banker not long ago in a conference in Atlanta who told me that they were seeing tens of thousands of attacks on their system a day in the form of phishing, attempting to hack into various databases and steal information. So they were spending a fortune on constant upgrades for cybersecurity. Now, I'm going to say this, and again, this is a topic for another seminar. It's certainly one that we're going to do and have a discussion about. This creates a huge opportunity for those companies providing cybersecurity systems to banks. Vasco Data Systems comes to mind, as does, believe it or not, Unisys. Major opportunities for long-term investors, major headache for banks, especially, again, the smaller ones. They're already getting pinched by the regulatory costs, and now they're having to lay out fairly serious money to deal with a very serious issue, cybersecurity. Okay, now we talked a little bit about those takeover multiples, and this is a chart put out by S&L Financial, one of the best research firms in the world for banks. You can see the price to tangible book value peaked out back there, 1996, and boy, I got to tell you, that was just about as much fun as you could ever have being a broker. Because we had bought all those stocks back in 92 and 93 when they were trading at, minuscule, 60, 70% of tangible book value. And over time, we sold them for as much as 250% of tangible book. You can see the average got all the way up to 263. In 2007, we were up there. 2006 hitting about 240%, stayed over 2 times book as we got into 2007. And then, of course, the bottom fell out. And this is the price that an acquirer is willing to pay to take over another bank. Right now, we're at about 140%, but there is a very important disconnect going on out there, and we'll talk about that a little bit. The smaller banks are getting about, on average, as of the end of 2015, 112 percent of book value. That's the very smallest banks. Decile 2 and 3 is where we make most of our money as bank stock investors. They're getting 137 and 128%. When you get those banks with the higher asset levels and the higher returns on equity, you can see premium multiples of up to 178% on average are getting paid for these things. So if you can buy a premium high return on equity, high asset bank for, say, less than 120% of book value, I think you have to think about that. We added one to the portfolio not long ago that had a very attractive return on equity. We paid up a little bit for it, paying 101% of book value, because I think that multiple is going to be a lot higher on a takeout basis than 140%. They're grown at a decent clip, had a solid return on equity. So we do take that kind of into consideration. Right now, we're staying primarily in the decile 1, 2, and 3s just because we can buy them so ridiculously cheap. And for now, that's where all of the activist activity has been. So about 140% on average price to tangible book value for a bank takeover right now. But there is a disconnect between the smaller, lower performing banks and the larger, higher returning banks. So you need to be aware of that. Don't go in here buying an $80 million bank, think you're going to sell it for 160% of book value. It's probably not going to happen. If it does, it was a very good day. Take yourself out to dinner or something, because it's not going to happen too often in this environment. But again, if you buy these things right, 70, 75% of book value for these very, very small ones, and you sell it for 112, you're not exactly mad at yourself at the end of the day. Now, there has been some talk, and this is a chart from a recent banking update, the FIG Partners March update. There are some concerns. There are some bank classifications that are really growing rapidly. A lot of banks, especially in that $1 to $5 billion ranges, they're looking to really grow and accelerate their growth. They're turning away from the very, very competitive and low margin residential mortgage loan, and they're getting aggressive out there on the commercial real estate loans, multifamily loans, which of course has just been the absolute hottest segment of the real estate market, because kids growing up today, and I've got one. He has no interest in buying a house. He's making a decent living. He and his friends enjoying life. They want to retain their flexibility as far as their career, family options. No interest in buying a house at this point in time. So multifamily should actually remain pretty strong. The other ones, commercial and industrial loans to businesses, they're really focusing on that out there. They're trying to get out there, take these loans away from the bigger banks, and they're doing a pretty good job. So we've got a lot of growth in commercial, industrial, and in construction loans. Now, the C&I loans, I don't worry about too much. I do worry about construction loans, accelerating construction loans. That's, to my mind, the riskiest type of real estate loan that there is. So the growth there concerns me a little bit. Commercial and industrial, not so much, because the numbers had dropped so far. We're nowhere near, as you can see, we're just kind of nowhere near the 2005, 2006, 2007 levels compared to the amount of money earned by the corporation. So I think that those loans are probably okay. The economy is not great, but it is sort of muddling along. Some areas of it, are pretty hot. I think the C&I loans will be okay. Construction loans have always been a major concern for me. But the truth is, as good as, as fast as these loan segments are growing, lots of attention, lots of sales and marketing being spent by these, as I said, it's mostly the larger end of the small banks and the mid-sized banks are really going after these loans because they don't have that great an interest in the residential mortgage market anymore. It's far too competitive, far too many non-bank lenders in the space. Even with that happening, however, we take a look here. We looked on BankReg data last night. Now, you can see commercial and industrial is the largest loan classification, but if you take the average of all banks across the United States, only 0.78% of those loans are 90 days past due. Your residential mortgages, 4.26% of those are past due. Commercial real estate, only 0.86%, and those numbers are even better for owner-occupied commercial real estate, by the way, are 90 days past due. So you get down into the multifamily, it's 0.28% of all loans are 90 days past due. Here again, look at the BankReg data, you can see that the trends are primarily positive, with the non-performing assets actually decreasing. You've got a little tick up from 0.69% to 0.78% in commercial and industrial. And farm loans ticked up a little bit from 0.44. We've been, farm lending is a great business, but there's not too many banks in it. I think we recommended one the other day that had some agricultural exposure. Most of the guys in this business know this business. So that slight tick up, again, it's at a low. It's the lowest in several years. So we're not really worried about the 0.44% of all farm loans being 90 days past due. You just don't have any serious problems developing very quickly. We may have seen the the peak of the credit cycle. It may just get worse from here, but it's going to take a very long time to do so, with one exception. Okay, the banks that have heavy oil exposure, we looked at a couple this morning where the energy portfolio was actually larger than the total tangible equity of the bank. Now that's a huge problem. So banks with heavy energy exposure could struggle quite a bit if, in fact, oil does stay lower for longer, as many folks seem to think will happen. Moody's just downgraded a bunch of banks that have a lot of energy exposure, and they're saying, look, we think it stays lower for longer. We think that the domestic energy companies, particularly the smaller ones, they're going to have a real hard time paying these loans back, and that's going to hurt some banks, destroy some equity. We may well see some bank failures as a result of energy lenders. So now, as bank stock investors, we had to find a way that doesn't hurt our overall return. So we came up with what I think is a very elegant solution. We just don't buy them. We have tiny bit of energy exposure in our bank stock portfolio, but it's more accidental exposure than anything else, where they happen to make a loan to a energy company. We do not have any banks in our portfolio that have an aggressive energy marketing department, as do some of those that are going to run into trouble. Now, are we going to avoid energy altogether? For now, absolutely. Now, when there's more FDIC regulators and examiners wandering the streets of Houston than there are oil executives, I'm going to get kind of interested. When I hear that Gerald Ford and Andy Beal are burning up the highway with calculator and checkbook in hand between Dallas and Houston, I'm going to get pretty interested. But it's going to be a while from now, and we're going to be buying the survivors after the apocalypse. We're not buying pre-apocalypse. That's how you lose a ton of money. I'm not smart enough to know where oil prices are going to go. I don't feel too bad about that. One of the smartest guys I've ever met in my life said the other day that he spent 15 years, and this guy's a fantastic trader, by the way. He's a legend in the industry. 15 years trying to figure out a way to successfully trade and predict oil prices, and he came up with nothing that worked. So I don't feel too bad. I think the few guys I know that actually trade oil, they're like the grain traders that I know. They know where every drop of oil in the world is, who bought it, who's going to sold it, who's storing it. They're just wired in to the oil industry. So for now, we're going to avoid problem lending in the energy sector by just not buying any banks that have exposure to the energy sector. Just think that makes a lot of sense. We're trying to rack up solid long-term returns by buying high-quality, safe little banks and selling them at higher prices to an acquirer. Energy doesn't fit into that scenario right now. It might in the future. We'll let you know. It's going to be a long time, no time soon. Okay. In the sector, activist investors remain very, very strong. You see, a recent Reuters article said, activist investors are putting the U.S. banking sector in their crosshairs, betting that the headwinds whipping through the industry will accelerate consolidation among lenders. It's happening. We're seeing filings start to pick up. We reported on 6 in the last month in the issue of Banking on Profits Monthly that went out yesterday. And it's all the usual suspects, the ones we like to follow. We keep pretty close tracks on who the activists and bank stock specialists are out there, because frankly, we make a lot of money stealing their ideas. We've also done a recent internal study, and we're starting to share the results with some of our subscribers. When we went back, we took the Stern AG data, we looked at that, and we said, okay, great, these are significant excess returns over the holding period, but as one of our readers pointed out, they didn't tell us what the average holding period was. So we've gone back through and started to look at annualized returns from the day of the 13D is filed until the day the activist exits, either by selling the stock or the bank being sold. And I have to tell you, the returns are outstanding, running from the mid-teens up into the low 20s on an annualized basis for the activists we've studied so far. And that's covering from 2006 to 2016, a period where the bank stock indexes did not do very well at all, and really neither did the S&P 500. So following the activists makes a lot of sense. It's one of the things we do very well in Banking on Profits and Banking on Profits Monthly. So the activists, they're out there. They're very active. They're still finding a lot of banks that they think need to raise dividends, improve operations, buy back stock, or just simply sell the institution. Going to see a lot more of that in the years ahead as the consolidation trend does, in fact, continue and accelerate. And I think we're well positioned to make a lot of money from that. Okay, Banking on Profits is a source of monthly returns. Now, I'm pretty proud of Banking on Profits. We put this out. We started it as a monthly edition about a year and a half ago. We started adding bonus picks about this time last year. But we really give you a nice overview of everything that's happened in the month in the community banking sector, in the economy, to some degree in the broader markets. But we also track really closely 13D filings, and we report on all the 13D filings for the past month in the community bank sector. We also, most months, will give you a couple of bonus pick stocks that we think are positioned to do real well and are legitimate candidates for a Banking on Profits Trade of the Decade portfolio. So we're trying to only deal here with positions held a year or more. But we're going to go back through and do the returns from every issue. But in May 2015, our bonus picks ended up 15.02 against the market that's down a little bit. In the February 2015, 3 stocks with recent 13D filings, average returns if you bought them all of 21.76. The bonus picks from last April, I think that was the first month we did bonus picks, up 16.66 against the flat market. 415, that same issue, there were 4 13D filings, average gain of 14.01 to again a negative number. In the March issue, we covered 4 13D filings as well, 4 or higher. The average is 16%. Point being, you can use Banking on Profits as a regular source to stay informed on what's going on in the community bank sector, what insiders and institutions are buying, what the FDIC and the Fed and the other regulators are doing, and how the bankers are responding to it. We do a fantastic job of keeping you on top of what's going on in the community bank sector, and I think in the economy as a whole. And we're going to give you ideas, resources, and tools to make money in the stock market as part of the Trade of the Decade. It's really a great little publication, and we've been able to keep the price, I think, pretty reasonable. Okay, now, Banking on Profits, we're going to call it the Gold Edition. This is the one where we have the guided portfolio. We send you buy and sell alerts every time I buy or sell a little bank stock in the portfolio. Regular weekly updates, the regular weekly reading list of articles that has caught my eye and my attention during the week that I think will help you be a better investor and understand community banks even better than you currently do. We take a look in the first full year of operation, 2014, we did 14.04%. Last year, 8 takeovers, shot the lights out, 30.04%. Fantastic year. Down, that number is actually a little bit better this morning because the little banks are having a pretty good day. Down a little bit less than 1% so far in 2016. Only had 2 takeovers in the portfolio this year. And I think if you focus just on the buy list stocks, you've done a little bit better than this. But for the entire portfolio, 0.93. Over the last 12 months, we've returned 22.61% in the banking on profits portfolio. That's not too shabby, guys. Uh, Banking on profits and investing in the community bank stocks can make you a ton of money. You should be subscribing to either the monthly edition or even the gold edition is the recommended one, because I've kind of gotten good at this stock picking thing over the years. So 2014, 14.04, a little bit better than the market. Just absolutely crushed the market last year. Fully expect that we end 2016 with strong market beating returns as well. If you take a look at the gold portfolio, we've closed 16 trades so far. The average return, I think, it's a little bit over 60%, if I recall correctly. Largest drawdown was less than 10%, up 3.25% over the last 90 days. And of course, there's your 22.61 over the last 365 days, beating the market solidly since the inception of the letter 2.5 years ago. Here's our closed trade history. You can see we tend to exit via takeover, which means that we tend to exit with some very large gains. Our holding period is very long. We're going to hold until we think that the price to book value gets too high, non-performing assets start to rise, or we see too much selling by insiders or activists and bank stock specialists. We buy these with the intent we're going to hold them until somebody makes a bid for the bank at some point in time. It's been our strategy for well over 20 years now, and I have to tell you, it's worked pretty well. So our current buy list just went out last Friday afternoon. And remember, there's 70 plus stocks in the portfolio because we tend not to sell stocks, so we still have the ones we bought a couple years ago. The buy list right now had 32 stocks. Our average price to book value was just 82%, 1.01% average dividend yield. So you do get some dividend cash flow, but a lot of our banks are smaller banks that do not at this time pay a dividend. We do expect to see going forward a relatively high dividend growth rate, because a lot of these smaller banks are doing a great job of buying back stock below book value and increasing shareholder payout over time. So we think we'll see decent dividend growth from that 1.01%, which is still better than most bank products. Average market cap is $54.16 million. We do tend to buy the smaller banks, not real interested in Bank of America or Citigroup or any of those. Our money is made in the smaller banks, where most institutions and large investors simply are not involved. The only ones down here buying these banks with us are the activists for the most part, and having them in the shares is just a very good thing. They're in great financial condition with equity to assets ratios on average 12.06%. That's above the industry average. And non-performing assets on average are less than 2%. So these are basically smaller banks, strong balance sheets, solid loan portfolios bought at very attractive prices. And again, you can see the opportunity here if you think about this. You've got average price to book value of 82%. The average takeover premium is somewhere around 140. Even if you slide this back a little bit, because a lot of our banks are slower, these things are trading at a significant discount to what they're worth in a takeover. So all we've got to do is buy them right with time and value, take care of the rest for us. Now, we do have a special offer for you guys right now. It's on the monthly newsletter, Banking on Profits Monthly. It's normally $199. We're going to make that available to you for just $99 a year. You get the regular monthly commentary, the focus stocks, the quarterly 13F reviews, where we show what all the activists are buying in a particular quarter. You do get the weekly reading list. We do send that out to you. All the articles that I've read during the week on community banks, and sometimes on the market as a whole, life, its own self, the economy, whatever struck my eye that I think will find you useful and help you become a better investor. You get that list every Saturday. Most of the time, sometimes it goes out Friday night if I'm feeling really ambitious. You do get the one-on-one messaging capability. You can send me a little email and I'll get back to you, usually right away, but always within 24 hours. So if you have specific questions about something that you read in the issue or about the banking industry as a whole, you can feel free to reach out and message me, and we can have a discussion about the things that you're interested in. So $99. That is a fantastic offer. You also, by the way, there's a little click you can download last month's March's issue. So you're actually getting 13 months for $99. Usually we charge $199 a year, which I think is a great price. Here it is, roughly 50% off, a free issue. I hope you take advantage of it. And here's the link, just vip.marketfi.com/bop-newsl/. And then if you want to just check out the Banking on Profits Gold Edition, there's a link where you can do that. Just item banking on profit / / Anyway, that's in the video. You can see it. Go to there and check out these editions. But I do hope you join at least the Banking on Profits monthly if you're not already a member. I know a lot of you are. So I hope that you do, in fact, join us in our little banking adventure here. I think it's going to be extremely profitable. It's going to stay profitable for a very, very long period of time to come. Okay, guys, that's the end of our presentation for this week. As I said, we're going to try to do a lot more of these going forward. We'll look at different industry groups. I certainly want to go back through and do one on cybersecurity. We're probably going to talk about energy at some point in the future. Going to keep trying to upgrade the sound and the video. Going to get the teenager to come in here and show me how to really work these cameras and effects so we can get some pretty cool presentations out there for you guys every week. Anyway, down here in Central Florida, got a big night coming up. We've got the Orioles in Toronto. We've got the New York election results, which should be just an enormous amount of fun to watch, particularly all the various speeches. So pretty excited about that. Anyway, this is Tim Melvin down here in Central Florida, coming to you with the State of Banking April 2016 Trade of the Decade Update. I hope you enjoyed it and found it informative. And as always, if you have any questions, feel free to send me a quick email and we'll talk about it. We'll talk to you guys next week and we'll see what kind of neat stuff I can come up with for the next video.